Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. The main event of the day is already behind us, which is President Trump's speech out of the White House. And, well, it's more of the same. Attacks continue. Two-week timeline reinforced. Oil prices have spiked. Equity futures are down. Asia has spared gains, etc., etc. You know the drill. We are coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Mangalam and Nigel. Guys, hi, morning.
Hi, good morning.
Morning.
If there was any literal representation of how the night changes, yesterday we did extremely well on Wall Street. We did well in our markets as well. The highs obviously didn't sustain because there was that eerie sense of discomfort, and that discomfort played out today itself. 20 minutes of Trump's speech, and the GIFT Nifty, which was a 50-point uptick, is down 450 points, so near 500-point downtick. And that's the similar kind of cut that we've seen across the board. So that's how the night changes.
It was April 1st and Donald Trump fooled all the bulls.
Nice way to put it, Nigel. Absolutely. And I think, it's as I said, it's more of the same. And the expectation was that it won't be more of the same. It'll be perhaps something else. And over the last 24 hours, maybe 36 hours, starting with that Wall Street Journal reportage, the hopes had come up a little bit, and you could see it on oil, you could see it in yields, you could see it in equities, and etc. I mean, the entire range of stuff, right, which moves on the back of all of this. On your screen, GIFT Nifty, right? What else is there to say? Now, Trump, just a bunch of things, and we'll play the sound bites out. That's Brent oil prices, which was basically tracking up. You could just look at S&P futures and oil prices and GIFT Nifty in one screen, and it was basically oil going up and the other two going down, tick by tick, as President Trump, started talking. Now, this is what he said, basically, that strategic objectives are nearing completion, which means that they're not completed yet. That's one. We are going to finish the job pretty quickly. Pretty quickly was kind of an afterthought, although he did say it a few times. And he said, well, we will hit Iran very hard over the next 2 to 3 weeks. There was no talk of, in that speech, there was no talk of putting boots on the ground, basically putting American troops on the ground in Iran. There was none of that, no mention at all. Although we are getting some reports, etc., that maybe that plan is also now moving forward. We'll see if it really comes to that. But, what we heard was just a reiteration of what we've heard from President Trump in his Truth Social posts and elsewhere, the commentary. I mean, basically a mix of all of it. And that 2 to 3 week timeline was reinforced once again. Basically also said, well, we won't let our allies, Israel, Saudi Arabia, Qatar, Bahrain, in the Middle East get hurt. And of course, I mean, as I said, as he said before, urging countries who are getting oil through the Strait of Hormuz to come and get it. And, show some delayed courage. These are all words and phrases we've heard from President Trump earlier as well. So I think it's pretty straightforward, right? It basically means that the conflict continues, the strait stays shut, oil prices remain higher maybe for longer, as has been the fear, which basically means it's a real macro impact, especially for the large oil importers, especially in Asia, Southeast Asia, South Asia and North Asia, where bulk of the oil comes through that strait, where the impact is basically going to be felt the hardest. That's what you're seeing. Last night, it was all in anticipation. I mean, it's moot in terms of what happened. Equities were extending gains on the back of hopes, and 2-year yield had gone up about, I think the only thing which will stay is yields, which went up 6 basis points last night, and perhaps they will go up even more because inflation will come back front and center as hopes of quick de-escalation kind of goes away. That's where we are at right now. Now, I'll just tie in the levels, basically, again, on that small channel connecting the two recent highs and the two recent lows. So the two supports are 22,450 first. It's a minor support, but the important one is the second one, which is 22,283. Those are the support levels, and the resistance on the channel on the upper end is 23,180. GIFT Nifty, once again, indicating a 400-plus point cut, basically reversing everything that we gained yesterday and then some if we get that open and stick with it. Tomorrow, of course, is a holiday, not just for us. It's the Easter weekend. Global markets are going to be out. But the fact is that headlines out of Iran, etc., will not change, which also, of course, means that it's kind of a double whammy at times like this because the news will keep coming, but there is no way to express it through price action. There is no price discovery anywhere. And then suddenly you'll wake up with all of that when we come back on Monday. So that's the peculiar situation we find ourselves in. Nigel has walked across the wall with a quick view on the positioning and the FNO stats. Nigel, over to you.
Well, Trump's comments on Operation Epic Fury didn't show any signs of de-escalation. In fact, the bigger worry is now we're headed into a long Easter weekend, followed by the expiry of the deadline given to attack Iran's energy facilities, which is on April 6th. Crude oil prices, well, they have reacted. Sharp uptick is what we have seen post yesterday's mild correction. Yesterday will be termed as best, actually, for the equity markets as a relief rally because the FIs, they didn't get fooled by Trump. They continue to sell big, though the DI buying, well, that more or less offset most of what the FIs sold. For the markets on the whole, though, there appeared there was some kind of a short covering bounce that played out, particularly on the Nifty bank, because the index ended higher and the open interest was down sharply. Though from an FI perspective, well, they added 6,000 contracts, both on the long as well as on the short side, on index futures, that is. While on the stock side, there was some covering that we saw on the short positioning on the stock futures. The FIs, well, they remain aggressively net short at around 2.64 lakh contracts, which equates to around 84% of their total positions on index futures. Additionally, the FIs, they continued writing more calls than puts, and those calls were written at higher levels as well. So the Nifty saw writing at around the 23,000 call. There was some action as well at the 22,700 put, which gives us the broad range since there was writing at both these two levels. Premium out there at around the 22,700 put came down to around 300 rupees or thereabouts. So on the downside, 22,700 put minus 300 rupees, 22,400 becomes the near-term support, which is around last week's low of around that, the 22,471. That's going to be the important support zone. While yesterday's high of around 22,941, that becomes the first level of resistance. While the options data suggests that at around the 23,200, that's the level that the bears will be looking to defend. These are the resistance levels. The Nifty, well, it's ended in the middle of that broad 5,000 point range that we have been working with. The recent high and the low, well, they'll serve as a goalpost, with the 20-day MA becoming the extremely crucial resistance. From a financial market perspective, well, it appears now the ball is in Iran's court to stop the war, and that will give investors continued sleepless nights. So we pull back close to 400 points kickstart trade. The bulls will at least want to prevent further damage post the morning gap down, but it'll be an interesting trading session after the kind of rally that we saw yesterday. Mangla.
Take that point. 350 point uptick is what we saw yesterday. 430 points straight out the bat as per the GIFT Nifty. Let's see whether we test earlier lows, Friday lows of around 22,284 or not once again. On the equities front, Mahesh Nandurkar of Jefferies says that the recent market correction has brought the Nifty 12-month forward PE multiple to 17 times. That's close to pre-COVID average and a 12% discount to what we've seen over the last 5 years. While EPS cuts of 4 to 5% are possible for March 2027, large cuts for March 2028 appear unlikely if the West Asia war ends by April. Jefferies, as a result of which, increases their overweight on banks, pays pharma, while cut autos, cement and BPCL. He also adds that real estate remains the best non-consensus buy and that their bear case implies flat Nifty until March 2027.
Okay, there's one more, right? This is Chetan Seth of Nomura who says that they have downgraded India equities to neutral from overweight since the Iran war broke out. Nomura has consistently flagged the vulnerability of Indian equities to a scenario of protracted conflict and elevated oil prices, while yesterday's news flow and a rebound in global equities and optimism around an imminent end-of-war narrative has reduced tail risks. They are concerned that prolonged disruption in oil energy flows via the Strait of Hormuz can still keep oil prices elevated longer than they had initially hoped for. I guess, after President Trump's speech, because I guess the note came out yesterday, they're right on in terms of their assessment that oil perhaps stays higher for longer.
Indeed, and President Donald Trump, in his address to the nation on the ongoing war in West Asia claimed that the United States' core strategic objectives on the war on Iran were nearing completion. Remember, this comes hours after he claimed that Iran had asked for a ceasefire, a claim that Tehran denied. So there was an uptick in the market thereafter, and then a downtick as we go into trade today. All important to listen in to what he had to say.
From the very first day I announced my campaign for president in 2015, I have vowed that I would never allow Iran to have a nuclear weapon. Tonight, I'm pleased to say that these core strategic objectives are nearing completion. As we celebrate this progress, we think especially of the 13 American warriors who have laid down their lives in this fight to prevent our children from ever having to face a nuclear Iran. And we are going to finish the job, and we're going to finish it very fast. We're getting very close. I want to thank our allies in the Middle East, Israel, Saudi Arabia, Qatar, the UAE, Kuwait, and Bahrain. They've been great, and we will not let them get hurt or fail in any way, shape, or form. We've beaten and completely decimated Iran. They are decimated, both militarily and economically and in every other way. And the countries of the world that do receive oil through the Hormuz Strait must take care of that passage. They must cherish it. They must grab it and cherish it. They can do it easily. We will be helpful, but they should take the lead in protecting the oil that they so desperately depend on. I've made clear from the beginning of Operation Epic Fury that we will continue until our objectives are fully achieved. Thanks to the progress we've made, I can say tonight that we are on track to complete all of America's military objectives shortly, very shortly. We're going to hit them extremely hard over the next 2 to 3 weeks. Yet if during this period of time no deal is made, we have our eyes on key targets. If there is no deal, we are going to hit each and every one of their electric generating plants very hard and probably simultaneously. We have not hit their oil, even though that's the easiest target of all, because it would not give them even a small chance of survival or rebuilding. But we could hit it, and it would be gone, and there's not a thing they could do about it.
Right, that's Donald Trump on Epic Fury, which actually, unleashed Epic Fury on the markets itself. We've seen a big cut on the Asian indices this morning, along with the US futures and GIFT Nifty as well. So to discuss this point further, we do have with us Drew Pettit, who's the Director, US Equity Strategy and ETF Analysis Strategy at Research. Along with him, Art Berman, who's the Energy Analyst at Labyrinth Consulting Services. So Drew, how much wiser are you after Donald Trump's speech than were you before that?
I really don't think much has changed, to be honest with you. We've been calling this a little bit of information overload. I guess you can almost say it this way. It's a bit of an information void because you get some news on one side and then you get conflicting reports. I would say tonight we really haven't had anything new. You know, I'm not sure we're closer to the end versus the beginning. At the end of the day, we're going to take our cues from the oil markets, and we're seeing Brent move higher outside of the U.S. close. So right now, not much new for us, still a little bit confused. We think it really does create some headwinds for risk assets, U.S. equities and global equities in general.
Take that point, and that's exactly why, we'll get an Art's word as well. Art, the futures are reacting. The Brent futures are reacting immediately to news, but cash crude isn't reacting. It's still at high levels, upwards of 120, 126. What's your sense on the way the crude prices are, the commodity prices are, on how far are we away from some sort of de-escalation?
I don't think we're anywhere close to any de-escalation. The reason that Brent is rising is because it dropped considerably today because the contract rolled from May to June. So if you recall, it was $118 on Monday, and then the contract rolled and it went down to 100, and now it's going back to 118 or higher. The problem with the oil market is that nothing that Trump said changes anything about Hormuz. It doesn't change a thing. And so what we're seeing is a gradual convergence of the paper markets, which have been more optimistic than the cash markets. And so now the futures markets are moving up, and eventually they will intersect the cash markets.
Yeah, and Art, you've been absolutely on the ball with this one, right? In terms of your expectations of oil, where this is headed. Good morning, Prashant here. Drew, good to see you as well. You know, I just have a question, and this is a hypothetical. If the objectives are largely, I mean, and President Trump has said that regime change was not the real objective, and it was for Iran not to be able to have nuclear weapons. And he said, well, they already can't. They've been set back 20 years or whatever, right? So now, is this about getting Iran to admit defeat? So what does de-escalation look like? Basically, everybody gets on the same message? You know, is that what this is about now? Drew?
Hard for me to really give you a clear answer because I think outside the White House, I don't really know what the answer is, to be honest with you. From a market's perspective, if we're going to believe that we're near the end of conflict, you have to see oil price volatility, interest rate volatility, and inflation expectations come back down. Until the market believes the narrative that we are close to the end and both sides are going to agree on how this is going to resolve itself, you're going to see volatility in all these different areas, which leads us back to our call and our view on the markets. Until you get that all clear, it's hard to put a higher multiple on what is still good earnings for a lot of the secular growth stories in the U.S. So honestly, to answer your question, I don't know. And the markets, even outside of equities, don't know, which makes it really hard to be overweight and aggressive on risk assets.
Drew, if this morning, again a hypothetical, if President Trump had announced that, well, they're done and they're sort of with operation complete instead of what happened, you think oil prices would have come off $10?
It's funny. It's not just the near term that we're even thinking about. It's the longer term. The whole curve would have to come back down. But you're really looking at oil prices 12 months out that are still significantly higher than they were, a month or two ago. So at the end of the day, input prices, whether it's oil, different commodities, and the offshoots of oil, it's still higher, and that's a headwind to margins for a lot of cyclical companies, especially on the consumer side. So look, market isn't buying it. Companies still have to live in this higher input inflation world.
Yeah. Art, same two questions to you. The shape of de-escalation, is it about getting everyone on the same message? And second, it's kind of almost two different things now, right? One is, end the conflict. The other is the straight reopening.
So a couple of simple comments. I'll be very blunt. We are nowhere near accomplishing any objectives in Iran. Full stop, end of story. Iran has done tremendous damage to U.S. and Israeli forces. We've expended a huge amount of firepower. If we had anything to show, he would show it. We don't have it. On the oil markets, the backwardation, the spread between the first month and the 6th month or the 12th month has never been greater in history. It's 120% more than it was at the height of the Iran crisis. So price is one thing to look at, but the shape of the forward curve is another. The markets are seeing almost a panic of supply failure and collapse. And my guess is that the markets have priced in that Trump would say nothing. And so tomorrow, you're today, we don't know, but whatever the markets do, the underlying truth that cannot be avoided is that the world is heading for an economic cliff. And as long as Hormuz is closed or even slightly closed, that cliff is unavoidable. And as markets wake up to this, they're going to freak out eventually. That's my take.
Yeah, that point that Drew and Art, both of you are making about forward oil 1 year ahead. Art, just explain that for our viewers. Because, you know, a year out, markets are expecting prices to be sharply lower, right? Not at 105, 100. Where are prices now, a year out?
Yeah, so a year out, they're at $80
Yeah.
on the future curve. That's not a prediction. That's just what somebody is paying for a low liquidity contract. But what's more important is the 6-month spread. Okay, and that's not anywhere near $85. But again, what the market is saying is that we are running out of oil supply. The last tankers that left Hormuz before it was closed are now arriving in ports. If Hormuz opens tomorrow, it'll be 6 weeks before new supply comes. That's what markets are looking at. Markets are going to be as optimistic as they can tomorrow and the next day. They're going to wake up to the truth the day after tomorrow, maybe sooner, and then we're right back where we started. I don't see that anything has changed. Hormuz was not addressed. The idea that other countries, Bahrain, Qatar, UAE, can just take it, it's easy. If it were easy, the United States would have done it. It's not easy.
Yeah, 100%. Art. And you said it's nowhere near accomplishing its goals. What are those goals, Art?
Those goals are to decimate Iran's ability to defend itself and to build a nuclear weapon. I have not seen any evidence. I mean, Iran's still sending ballistic missiles. Iran is still using drones to hit U.S. ships and U.S. bases. 13 bases are essentially useless. And so, you know, he's controlling the narrative. I'm not criticizing him. He's doing his job, but he's not showing any evidence. He's not showing any facts. And therefore, nothing has changed. And the reality is going to creep back. That's my call.
You know, Art,
and the reality's bad.
Yeah. You know, Art, the problem from an equity market perspective is that we're getting into a long weekend. And that deadline that he gave, that ends on Monday. You know, for attacking Iran's oil infrastructure. You think he's going to go the whole hog now? Because that's the biggest risk, right? He paused for a bit, but that deadline's coming to an end.
Yeah, I think the deadline, he's not going to hit Iran's energy infrastructure. I mean, he's an unpredictable fellow, and I don't know, but he wants to get out of this war. He doesn't want to prolong it. I mean, he's lost this war.
Yeah.
I mean, that's the bottom line. And he wants to wash his hands of it as quickly as possible without panicking the markets.
Yeah.
Okay.
All right. We'll leave it there, gentlemen. Art, always, appreciate your sharp, straight comments. Drew, great to have you with us. And enjoy the long weekend, Easter weekend. So wishing you all the best to your families. And, I can only wish we have lesser posts on social media and tweets and things to follow. We're going to have a peaceful 3-day weekend, but unlikely. Thank you very much once again for being here with us. We'll take a quick commercial break here. We'll come back and our list of top stocks to watch lined up on the other side with our research team. Stay tuned.
Back here watching us here on Bazaar Morning Call, Gift Nifty indicating a near 430-point downtick, but a lot of individual stocks on our radar. In fact, there's been a recovery from the lows. When we started the show, the Gift Nifty was down 430 points, now about 340 points. Let's see where we settle. If yesterday's high didn't sustain, the question is whether today's low will sustain or not. A lot of stocks on our radar, and let's go across to our team. Sudarshan joins in for the remainder of auto sales coming in on March. Sudarshan.
So on the basis of news flow, we are going with green color for majority of the companies reporting auto sales, but has to be factored in the sentiment of the market. So we'll start with Hero MotoCorp, overall numbers were largely in line. Wholesales have increased by nearly 9%, but positive part was the retail registration. That saw an increase of 24% in the month of March, and the demand continues to led by the 100 and 125cc segments, and motorcycle segment has seen a mid-single-digit growth, but there was a strong growth, double-digit growth for scooter segment, and also on electric front, electric two-wheeler sales have increased by 70%. Coming to TVS Motor, continues to outperform the peers. Both domestic and exports have seen a growth of 25% each in the month of March, and here electric two-wheeler sales have increased by 44%. For Eicher Motors, company continues to report monthly sales of more than 1 lakh units, and its a bike up to 350cc, that forms nearly 90% of total sales. There the growth was almost 12%, and bikes more than 350cc, that saw growth after 5 months, and this segment too has registered growth of 5% in the month of March. So I'm going with green for all three.
Got it. Thanks a lot for that, Sudarshan. Well, I'm looking at NMDC, and they have come out with their March performance, which looked quite good. But keep in mind, it came on a low base, because the same time in March 2025, they had a labor strike, and because of that, the Chhattisgarh operations got hit. So for the whole, you have the production number that was up close to around 50%, with the Chhattisgarh part of the business, which is most of the production, that was up by close to around 61%. Even the sales numbers look quite good. That was up by close to around 40%, while the Chhattisgarh part of the business, that was up by close to around 56%. For the year, production has scaled more than 20%. That's the jump that we have seen, while sales numbers were up by close to around 13%. Put everything together, and we expect the stock to maybe outperform today. Unsure whether it's going to be green because of the kind of markets you're going to have, but a positive update. Going back to Sudarshan though, Sudarshan, you have some more stocks on your radar?
So we'll start with Indigo. Company has revised fuel surcharges, and that will be effective today. So for domestic route, it's both revision downward and revision upward. So new charges, fuel surcharges for domestic routes are in the range of 275 to 900 rupees versus earlier charge of flat 450 rupees. And for international routes, it's a sharp increase, and new charges are in the range of 900 to 10,000 versus earlier range of 425 to rupees 2,300. Next one is Vodafone Idea. Company has seen a subscriber addition on a monthly basis after 5 years, or say for the first time since January of 2021. And addition in the month of February was 21,927 versus loss of more than 4.11 lakh that company had reported for the month of January. Last one is IOC. Company has reported throughput, refinery throughput and other throughput. So FY26, it was the highest ever, but Q4 numbers are looking disappointing. Q4 refinery throughput was up just 1% on a sequential basis versus 10% increase in Q3. Pipeline throughput down 1% versus 14% increase in Q3, and consolidated sales volume have dropped 2% on a sequential basis versus 12% increase that company had seen in Q3.
Right, and there are some more stocks in news as well. So let's go across to Winnie, who's joining in with that list. Winnie.
Hi, good morning. So first up, Prestige Estate. Now they've actually secured a prime land parcel which is in Gurugram. This is a JDA for around 17 joint development agreement. That's for 17 acres of land parcel. Saleable area of this is going to be 3 million square feet. And what is the gross development value for this? 4,200 crores. So we could see some green here. VMAT. Q4 update, good update that's coming from the company. Revenue growth of around 24.5%. That's at around 971 crores in terms of revenues. SSSG is seeing a growth of around 12% as well. 29 stores open, 6 stores closed. Overall store stands at 557. Good update as of now. Green expected here as well. Indian Bank, I would expect some bit of a green here as well. Total business is up 13% YOY. Advances are also up 13.6%. Deposits up around 13% as well. Overall CASA ratio has come in at 39.86%. Not bad on that front as well. So yes, we could see some bit of a positive here. Stock is not too cheap yet versus other banks. So that's something we'll watch out for though.
All right, a bunch of updates coming in and a joint development agreement with Prestige. Thank you, team, for joining in. In case you missed it, a quick recap of all the stocks that we are watching today. Once with positive news flow. In a weak market, we have Hero MotoCorp, TVS Motors, Eicher Motors, NMDC, Interglobe Aviation, Vodafone Idea, Prestige Estates, VMart Retail and Indian Bank, while Oil India, or rather Oil, IOC, is the only stock on our radar which is likely to have bad news backing it. Right, with that, let's shift focus. Sources say that HDFC Bank is penalizing 12 executives, including senior leader Ashish Parthasarthi, over alleged mis-selling of Credit Suisse AT1 bonds. Furkan, our colleague, has more on this.
So this controversy around HDFC Bank somehow refuses to die down. We now learn that the bank has penalized 12 executives for alleged mis-selling of Credit Suisse 81 bonds. This is in addition to the 3 personnel who had been sacked by the company for mis-selling these bonds in March this year. Of the 12 personnel being penalized now, we learn that 4 face severe penalties and 8 face minor penalties. Now, what makes this action significant is that Ashish Parthasarthi, the group head of branch banking and treasury, is one of the 12 people being penalized for the mis-selling. Sources also tell us that the major penalties range from withholding of ESOPs to the cancellation of increments. Parthasarthi was the reporting manager of Sampath Kumar, who served as group head of branch banking West and South regions. CNBC-TV18 reached out to both the bank as well as Parthasarthi for their comments on this development. Neither has responded as yet, though it must be noted that the bank is in its silent period ahead of the fourth quarter earnings. Back to you.
Thanks a lot for that. So we'll keep an eye out on all those updates with regard to that big boy HDFC Bank. But let's of course Manisha Gupta. She joined to give us a complete roundup of all the commodity action. Morning, Manisha.
Morning, Nigel. Thank you for that. Well, after the U.S. president's speech, we're looking at a big reaction coming in for the commodities. I'll start with the crude oil prices, which have gained nearly 5%. Almost $106 a barrel is back in sense of crude oil prices. Well, 4 weeks are done, and the U.S. president has spoken about another 2 to 3 weeks, and the Strait of Hormuz will remain shut during this time. And he's also said that if there is no deal, they will hit each and every one of their power plants, that is in Iran. So markets really reading in sense of further damage to facilities. And of course, the Strait of Hormuz staying shut means that the oil that is out from Middle East would continue to remain so, at least for the month of April. And that has added premium back in case of prices. The other thing that has gained after the U.S. president's speech is the aluminum prices, 3% up in the Asian markets right now. Remember, aluminum has been the best performer in sense of metals for the month of March, for the quarter as well, and continues to do so in the month of April. The commodities that have seen a decline after the U.S. president's speech has been copper down 1%, gold has declined by a couple of percentage points, silver is down 3% as well. The de-escalation of geopolitical tensions is something that the markets are not looking at with immediate scene, and that is what has led to some profit-taking continuing for the precious metal prices.
Right, Manisha, thanks a lot for that. Let's move on and get to an action that came in late last evening on Wednesday. Actually, the RBI said that a bunch of rules which further restricted the activities that Indian banks could do in the offshore NDF market. Last Friday, remember, the RBI had told banks that they must not have more than $100 million of open currency positions in the onshore market. Lata's here to explain all these new rules, the impact that this could have. Lata.
Well, practically, the rules don't allow any connection between the NDF market and the rupee market. They're telling banks to get off that market. That seems to be the sum and substance, but that's not how they put it. They say that banks will be not allowed to offer an NDF derivative to hedge a local position to residents or to non-residents, neither to FPIs nor to resident Indians, that is corporates. They can offer only deliverable FX contracts. Now, the offshore market is entirely non-deliverable. It's only cash settled. So if you're offering a deliverable forward contract, it has to be in the onshore market. That is natural. Banks are also not allowed to do FX derivatives with related parties. That's almost obvious. Now, banks must also not allow their corporates and their customers to rebook derivative contracts which are once cancelled. Now, this actually removes corporates as actors in the FX market. Corporates, all non-banks are told that you have to come to the market only if you have an underlying. Now, what all corporates used to do, exporters, importers, you have an underlying, you keep on buying, cancelling, so you're perennially in the market. When you say that you can't rebook a cancelled contract, you have actually, once that contract has matured, all these corporates are out of the market. The last I heard such a measure was perhaps when sanctions were imposed in 1999 after the nuclear blast. I mean, what I'm saying is that we have removed the kind of evolution of the market as far back as that. If not that, at least early 2000s. After that, we had all those Y2K dollars coming in, and corporates were allowed to become full-fledged actors in the FX market. Now we're pushing all that back. So let me tell you, it's a very serious move. There's no liquidity. Now, there's only interbank liquidity. Banks are the only guys who can trade with one another. What will this mean? Obviously, since selling is not allowed, The last I heard yesterday when deals were being done, it was 90 to 90, the spot dollar market. It's quite possible that it will open around that level, though nobody is giving me a level now, saying that it is highly illiquid. There is a quote in the offshore market, which is always a 1 month forward. NDF is always 1 month forward, and that came in at 93. That came in at about 93. 90, I'm told. So 92.90 onshore spot, 93.90 offshore, 1 month forward. Either ways, you look at the kind of recovery in the rupee. The last week close was 94.83. So you must expect a strong rupee now, but how long this will go and how thin this market is going to be, what are the implications of this market, we have to see, because we don't have a memory of that market. I mean, I have a vague memory. Most of the traders are younger to me. They don't have a memory of how that market was.
Got it. Thanks a lot, Lata, for joining in and explaining all of that to us. For the time being, we slip into a short break. Up next, we get chatting with the management of VST Tillers to discuss the past year as well as the way ahead. Anthony Keruka will be joining us. Welcome back. As promised, let's get chatting with the management of VST Tillers. We have Mr. Anthony Cherukara, the CEO of the company, joins us on the show. Hi, Anthony. Good to see you. Well, just to highlight the top points that we're going to be looking at, what's the revenue targets, EV opportunity, the timeline for entry into the US markets as well. Well, Anthony, we just got your numbers for the month of March, and in terms of growth for the year, it's been pretty good, particularly on the tillers front. Tractors are yet to pick up substantially. Could you tell us what went on in March? Was there any kind of inventory build-up, or was it purely because of a high base in March 2025 that the numbers look a little bit subdued? And on this sort of a base, the growth that you've given around 50,000 units in tillers and tractors close to around 6,000 units, what kind of growth can you give us for the coming year? Please go ahead.
Good morning, Nigel, and good morning, everyone. It has been a good year for us. The March performance has been normal. I would say the previous March was high considering the pent-up demand that was caused due to various reasons. So the previous March was pretty high. So this March was quite good, I would say. And the demand was overall quite good in Q4. And that is reflected in our numbers. The power tiller sales was upwards of 35% growth in the whole year. The volumes in the power weeder space was upwards of 52%. The domestic tractors have grown by almost 19%. We had a drop of almost 20% in the end of Q3, that is by end December. On the international business, we could cover up a lot of that in Q4. And we ended up on single-digit degrowth in international business. But given the circumstances, it has been quite good. And overall, the performance has been satisfactory.
All right. But you're not giving us the guidance yet. 50,000 units last year on tillers. On tractors, you did 5,900 or thereabouts. On weeders, I'm yet to get that number. If you could help us out with that. And what growth should we work with for the coming year?
Yeah, so the coming year is a bit tricky at this point in time. There is a lot of factors playing out. There is the war. The supply situation is becoming a little critical. If this war continues, there would be some suppliers who we face this a bit of an issue in March as well. In fact, on the tractor side, we could have done much more numbers, if the supplies were a bit better. So the war could play a role if it continues for a longer time. And then there is the monsoon, which is predicted to be not so good this year. So we're keeping fingers crossed. However, with all the new product launches, which you also mentioned in the beginning, that is the EV tiller, EV weeder, the new category of products that is coming between tillers and tractors, and the new range of tractors that we have already launched in Q4, which will scale up in Q1. We should be able to continue our growth, but to give a percentage or give a number at this point is extremely difficult.
But, if you had to not give a specific number, just a range is what we're trying to understand. Lastly, because, assuming that the war impacts your current business in the first quarter, you do have the second, third, fourth quarter to make up for that. Then you have some of the new products as well. Yes, you did say that March could have done better on the tractor business. 755 obviously is a lot lower than what the other peers have reported so far. So if you could give us a sense on what the market size or the opportunity for you is in the EV tillers, EV weeders. You've, planned a 60 crore capex out here as well.
Yeah, there is a huge potential in terms of mechanization to small and marginal farmers. We believe that bringing the EV tiller, EV weeder, the total cost of ownership for these machines goes down for these farmers and it will take off. But it's a new category. It's a new category creation that we are doing. And to give a specific growth target, specific number is extremely difficult, as I said before. However, we see a lot of potential. Couple of quarters from now, we would be much clearer in terms of how rapid that growth would be. But one thing is certain, that the small and marginal mechanization space, small and marginal farmer mechanization space is growing rapidly. And that is seen in our weeder growth, which is, I said, of 52% plus, the tiller growth, which is 35% plus. So I believe that kind of huge growth will continue in the EV tiller and EV weeder space as well. Yeah.
Okay, Anthony, numbers are getting a little difficult, but you had laid out this plan to get to 3,000 crores of revenues. Which year is that going to happen now, if you could help us out? And it'll have to be combined with some inorganic growth. So when do you hit 3,000 crores? And what about the inorganic growth? Is there something on the anvil that maybe you close out in the first half of FY27?
Yeah, we intend to hit it by FY30. That is what I've said before. To do that, we have to grow at about 24-26% around in the next 4-5 years at a CAGR level. We have already done that this year. So the first year has been good. We hope, even if some fluctuations due to natural causes like monsoon not being so good is there, but still we can cover up because the internal demand is good. Like I said, the potential for the small marginal farmer segment is good. The demand is continuing. The current scenario that we are seeing is supply-led, not demand-led, some constraints that we are seeing today. But I believe that the monsoon, if it plays normal or even, not so low compared to the normal. Let's say if it is in the range of 4%, 5% lower than normal, it will still be good for the mechanization space because the reservoirs are full comparatively. So it will play out well.
Right. So, Anthony, just to complete that point, you said by FY30, you intend to get to 3,000 crores. This year, you started well with 24-25% growth over last year, which implies about 1,200 to 1,250 crores is what you'll end FY26 with. If you can give us a sense on the 3,000 crore top line, how much of that would be tillers, how much of that would be tractors, how much of that would be EV, and at the same time, if you could give us a sense on how much of that would be organic and inorganic.
See, while the inorganic opportunity is something we are continuously exploring, we are looking at some strategic opportunities. However, it's very difficult to put a timeline to it. I would say that a lot of work is going on that.
This 3,000 crore target that you have is X of inorganic, right? Because inorganic, whenever that comes, that's just an addition.
I mean, organic alone at 24-25%, we should be there at 3,000 crores.
All right. Very quickly, what about the 25 acres of that Whitefield land that we have been quizzing you about for the last few years? Good time to unlock some value there. What's the update?
There is no update on that, Nigel. Like I have said before, that is a potential opportunity for us to unleash value and it will be done at the right time.
So as of now, there's no plan but?
No, thank you. Yeah.
All right, Anthony, appreciate you joining in, giving us some color. As you're saying, demand, you don't see a problem. Supply constraints could play a little bit of, create a bit of an issue in the near term. But 3,000 crores by 2030 and all of that will be organic. Appreciate you joining in, wishing you a good day ahead. And we catch up maybe post your quarter 4 numbers that you'll declare. For the time being, slip into a short break. On the other side, Deepan Mehta is waiting for us.
Welcome back. Dipan Mehta, who's the director at Elixir Equities, joins us now. Dipan, you know, the market does what the market is doing. It's up and down given Trump's comments, etc. We got to do what we know best, which is look at businesses and, you know, look at the prices and see whether they're investable or not. One of them that stood out in yesterday's session was Avenue Supermarts. We saw the company hit that 500 store milestone. 85 stores added in FY26 was the fastest that we've seen. And similar are the kind of store additions that we saw for players like Trent and even V-Mart Retail, which reported their update last evening. Do you think things are turning for the retail space? Are there any investable ideas here?
Good morning, Mangalam, and thank you for having me on your show. I think, yeah, it's a sentiment certainly has improved in these two companies because eventually increase in number of stores should lead to higher sales and revenue growth. But I'm just a bit uncomfortable with the valuations even now, and they are not. It's not that they are trading extremely cheap. Of course, they are trading way off the peak valuation which they were trading at earlier. But still, I think at about 50, 60 times or so, it is expensive. And end of the day, because of the base effect and because of the structure, they're not going to grow at 25, 30%, which they were growing earlier. Growth rates will kind of come down to 12, 13, maybe 15% or thereabout. So for a company which is growing at that pace to pay this kind of a valuation in such a market, I'm not certain. But existing investors, I think they can remain invested. I do feel that the returns from these companies will now more or less be in line with their net profit growth. And expecting a PE expansion is not really the right way. The better way to play consumption would be, through other stories like travel, tourism, which are down just now. But, post this war, you can see a revival over the airline companies. Then we have got the hotel companies. We have even online travel agencies, visa processing companies. That's the way I think to play consumption. And then, of course, I think there is the specialized retail companies, but those are also quite expensive. But I would wait for some correction over there. Like by that, I mean companies which are engaged into jewelry, or for that matter, specific articles like shoes or apparel. Those can be interesting bets rather than companies like Trent and DMart.
Interglobe Aviation, it's down about 30% from the peak, did well yesterday. Now the street believes that maybe, with higher fuel prices and as a result of which the consumer being protected, there could be increased volumes. And then there's new leadership as well. Willie Walsh has joined the company. What do you make of that development, and do you think it's investable at this price?
If also disclosure, we and our clients are invested in Interglobe Aviation, so our views can be biased. And I do feel that this is one company which is, of course, under a lot of stress just now for a lot of reasons. But look, end of the day, it has got a 55-57% type of a market share. And in terms of seat capacity addition, the way they are going, they will continue to maintain that kind of market share on a capacity basis as well. And a good year, I think, couple of years from now, when things settle down and oil prices are within control, this company can generate anywhere from 13 to 15,000 crores worth of net profit. It has done 8,000 crores a couple of years ago or so. So that's the potential of the company. And at that, if that is the potential of the company, then I think the valuations, like 1.3 lakh crores or thereabout, is quite attractive, I would say. But you have to have a lot of patience in this company, and you need to be able to observe the volatility which comes in the stock price and the quarterly earnings.
Absolutely, and I think that's a good way to put it. Dipan, hi, good morning. Defense was the other area, right, which went up, Garden Reach and Mazgaon and Cochin and HAL and BAL and Paris Defense and so on and so forth. Long list of, and the index was up, I think, about 3.5%, 4%. I think generally you've been a little wary because of high valuations here. Dipan, correct me if I'm wrong, and what's your view now?
Yeah, Prashant, it's a well-discovered sector, and to an extent, bit over-invested also. There's some amount of hype also around it because of the war. People generally make it a simple case that, of course, you're going to require more and more defense equipment, and all of those arguments are true. But I would think that they are largely discounted also. And these companies, I think, again, same case as we saw with the retail companies like Trend and like DMart. You cannot expect an expansion of the earnings. So their returns will be in line with their earnings growth, which may be decent, but there are a lot of execution risks as well. And this is what happens, I think, at corrections. People who are still underweight defense, they're the ones who try and, increase their exposure over there. So again, the same thing that, while we have investments in companies like BEL and HAL, and we like to remain invested, But from a fresh investment perspective, just wait and watch. I think the best time to buy defense stock is when there is peacetime, and that will happen at some point of time. But the long-term trajectory of these companies will not change whether there is war or peace, because Atmanirbharta is going to be the core policy for many, many years to come.
You know, just one more name, if I can, I don't know if you've looked at it, right? But this has quietly been the big mover over the last, I mean, that IPL cricket team deal which happened, right? RPG, I'm talking about RPG Ventures. It's just gone, you know, I think the value of the transaction compared to the market cap for the company, it just was, I think, too wide. And it has tried to reprice itself very, very aggressively. Have you looked at this one, Deepan?
No, but I'll tell you one more thing. There's Sun TV, which we had invested for a very long time and then threw in the towel because the core media business just didn't deliver. But Sun TV also has the Sunrisers Hyderabad, if I'm not mistaken, as part of their group. And those valuations, if you compare to Sun TV, then they are now, if you compare the same valuation, then I think 40% of the market cap of Sun TV you could attribute to their IPL team. So there are a few interesting plays over there, and certainly you could look at them. But Prashant, my focus is right now on more and more on companies which perhaps you missed out earlier, and which are solid in terms of performance and have a great story once this war is over. And there are large cap stocks as well. Companies like, say, we discussed Indigo, then there is L&T which comes to mind. And then there are companies in the auto sector, Eicher Motors, M&M. Look at M&M's monthly figures, very, very impressive. So I'm trying to think in terms of where I feel, we can improve the quality of the portfolio and buy into blue chip companies, which otherwise are always quite expensive.
Makes sense here. Thank you, Deepan, for joining in. And Sun TV, as of now, when we had pointed out when the RCB deal had happened, Sun TV accounted 65% of its market cap actually was accounted for by the Sunrisers Hyderabad, and that time RPSG Ventures was about 2,000 crore in market cap. They own 51% stake in Lucknow Super Giants, and now the stock has seen a big surge, over 30-35% in just the last few trading sessions.
And moved from, I'll tell you, it's moved from 550
to
936.
Yes,
950, yes, it's 4 days.
Yeah, so 35. Basically, the thesis is that if the team is
we're talking about RPG Ventures, if you can.
RPSG Ventures, yeah. So if the thesis is that 51% of the business is trading at around 6,000, 7,000 crore market cap, and the market cap of this company is 2,000 crores. Even if you apply a holding company discount, it's fairly wide. And this is not the only asset that they own. They do have a lot of other quoted investments of the RPSG group itself, which includes the likes of CESC and First Source and all the other retail ventures that they have, etc. So it's basically a holding company, and now the value is being unlocked via it being discovered through the deal that happened in RCB, which is Royal Challengers Bengaluru. Yeah. Has the deal happened yet? No. Is anything on the cards that suggests that maybe RPSG Ventures will monetize this stake? Not yet. But the street is just looking at the valuation discomfort and maybe.
I think as you guys have been saying, the divergence in the potentially realizable value to the market cap was just absolutely too divergent. And some of that gap has been filled. 3,000 crore in market cap now. We'll take a quick commercial break here. We'll come back. We'll get you the technical trading ideas and more in just a bit. There's about 3 minutes to go for the pre-open session. Welcome back. I think the pre-open session is coming up, and maybe we should just look at the rupee rate as well, because currency markets had been shut for the last 2 sessions. We've not had price discovery there, and we should have the first rates on the dollar rupee come up on show here in a bit. I think in a couple of seconds we should have that come up, and we'll put that up as well. Shilpa Rao is with us, Prabhudas Liladhar, and Sudarshan Sukhani is with us to run us through what they'd want you to do in terms of trades. Shilpa and Sudarshan, thank you very much for joining us. Sudarshan, you go first. How are things looking?
Well, good morning. Things are not looking good. That your screen is telling. But this is a market which is trying to find a base. Essentially, it is trying to say maybe the lows are coming in place. Therefore, I said this yesterday, last week, and I'm repeating. All the dips that we see, all the gap downs that we see now are actually buying opportunities. You have to have the courage to say this market cannot become zero. It's trying to see whether it can settle here. So every dip is a buy, including today's gap down.
Right. Yeah. And so basically, I was getting lost in all the with the holidays and all. Monday's low, right? Monday's low will hold, Sudarshan. That's broadly the.
No, that's not necessary. Lows can break by 100 points, 50 points.
Yeah.
The broad zone, that is the 22,500 zone should hold.
Yeah. 22,500 zone should hold. 22,283. Yeah, I take your point. 22,300 broadly was the low that we made on the 30th. Shilpa, what's your view? I think the dollar rupee is open. I think it's 93.53. So again, here what happened was that Friday we got to almost 95. Over the Friday evening, that circular was put out. On Monday morning, we hit 93.6 or something, 93.65. But by the close of Monday session, we had gone back to, we'd made a new low, past 95. 95, I think 95.20, 95.30 was the new low which was made on the rupee and a new high for the dollar rupee. And then you had 2 days of holiday. That was the last session. And we are coming back today, this Thursday, to 93.62. So there is once again a sharp move which is coming through. Monday's close finally was 94.83 after hitting a low of 95.20, 95.25, 95, almost 30, I think. And now we are once again back at Monday's high for the rupee. Almost at Monday's high for the rupee, which is about 93.53 or so.
It got immediately sold. It opened at 93.53.
Yeah.
And from there itself, it's been a 10 paise weakness. So 93.62 is.
Same thing happened on Monday as well, Mangalam, when that happened, right? 93.66. And people came in and bought the pair heavily, saying, well, this is not going to sustain. And that was the right call. Through the day, the dollar rupee went up. Okay, all right. So that's the currency which is opening up, and we're sort of, just highlighting because it was shot for the last 2 days, and there's a holiday tomorrow as well. Shilpa, what about you? How would you trade the Nifty?
Good morning, Prashant and Mangalam, and thank you for having me on the show. Nifty, we would say that again, like you rightly mentioned, 22,200 zones to be precise, to be in the new, support zones that one can look forward to. If that breaches, then 21,000 zones can open up as well. And the upside is very much capped at 23,200 to 23,500 band. So the range is very much in the middle, and out of nowhere, I know you can generate a fresh trading idea. It's just that, if you are positionally long, this is the best place to start accumulating and, build up your portfolio for now.
Got it. All right. Both of you all are indicating that time to show courage. Let's see how that goes. Sudarshan, you go first. Tell us some individual stock trades that you have for us.
Yeah, it's a mix. National Aluminium is a buy with a stop under 395. SRF is a buy with a stop under 2,510. I have two short selling ideas. Fortis, sell with a stop above 810. And Alchem, sell with a stop above 53.55. You are quite rightly said this requires courage. 5 years later, we will say, oh, if only I had bought it 22,500.
Take that point. It's always vision in hindsight is always 2020. Shilpa, your stock picks?
I would have, a couple of buy ideas. The first one would be a buy in Ambuja Cement. I had recommended yesterday in Prabhudas Liladhar as well. It has shown some good support. The support at around 400 zones should act as a good, levels to watch out for. And if it sustains above 420, then you will see a rally towards 440 to 450. The other one would be a buy in Hudco, also recommended yesterday from our research team in Prabhudas Liladhar. I believe, there's very limited downside. 160, 158 zones should be your stop loss. And if it holds that, then levels of 185 to 190 can be seen.
Right. Shilpa, Sudarshan, thank you so much for joining in. We'll get back to you at 9:10 for the 9:10 call. Meanwhile, Dheeraj Nim, who's the economist, FX strategist at ANC Research, joins in. Dheeraj, the late last evening circular that came in from the RBI, which basically cut the channels between the NDF and, the offshore market. What are your thoughts on that, the impact it could have on the rupee? This morning, after 2 sessions, the rupee is opened stronger versus the previous trading session's close, but that has been sold off. I mean, a little bit. 93.53 is where we opened. 93.62 thereabouts is where we are. Do you think that it continues on this slippy slide and we continue making newer lows?
Well, thank you for having me on the show. Look, I think there are two aspects to it. The Reserve Bank of India, through its recent circulars, is trying to clean up the onshore market of speculation and also limiting the impact the offshore bets, speculation, so to speak, would traditionally have on the onshore price discovery as well. Now, this means that, like today, the rupee opens gap up, stronger. There is a level correction there. But what it does not do, it does not rewrite the fundamentals for the rupee. Look, if oil prices stay where they are for much longer, you're looking at a much more painful current account deficit, and capital flows, of course, remain scanty. So there is a broader balance of payments issue. The RBI's moves aim at, removing speculation or its impact from the onshore exchange rate, is coming in handy in the sense that it gives the RBI more control over the exchange rate in such a precarious time. It also improves the efficacy of reserves intervention, but of course, it comes with its own pros and cons. At the moment, we still expect the rupee could continue to trade on the weaker side of things.
Yeah. Dheeraj, hi, good morning. You reckon the RBI is in the market this morning?
It's hard to say so. I mean, it's just very early to think about the price action and if the RBI is there. But this kind of a gap up opening was expected of the rupee because of the circulars that came in.
This is the new circular, which is coming, not the last Friday circular.
Right. The impact of both will continue to play out. Of course, the corporates will not be allowed to do all of those things that they mentioned in the last circular. But remember that the original circulars that prohibited banks from having NOPs higher than $100 million will have to be complied by till the 10th of April. And I think some of the trade unwinding can continue to happen till then.
Yeah, that's also true, because I mean those estimates of the size of the positions were anything between $20 billion to $40 billion. So we don't know how much of that got done Monday, and 10th is the deadline, right? Just this last circular, in simple terms, Dheeraj, can you explain what is new in this compared to what was the circular on Friday?
The Friday circular effectively prohibited banks, the authorized dealers, from dealing in the NDF market in any position size at the end of the day, which is higher than $100 million, which effectively limited the transmission through the banking channel of the offshore moves to the onshore market. Now, of course, what happened on Monday, and suspicion is that a lot of the banking positions were offloaded to corporates, kind of took everybody by surprise, and the rupee established a new low, which in turn hurt the efficacy of the last move. So I think the recent circular deals with effectively that even corporate treasuries, which effectively could have dealt in NDF with a tinge of speculative interest, can no longer do so. So effectively, all domestic participants, except banks to that paltry limit of $100 million, cannot participate in the NDF market, which means speculative impact on the onshore USD INR will be very, very limited.
So what you're saying is, and that's an important point, you're saying the suspicion was that banks transferred the exposure to corporates, and then, right? So then, and they were corporates. Large corporate treasuries could, do this arbitrage. They were free to do it.
To the extent they could, to the extent they could participate in the NDF markets themselves and via the onshore banks, they could have done it. But of course, now those limits have been set.
I'm just asking, was that happening in a very large way? Or this is just to kind of, this should be seen to back up the Friday circular by the RBI? Because, as you said, maybe banks had found a way out. So this is to plug that. Is this how this should be seen?
Well, certainly, I think it makes the previous rules more watertight and closer to the intent that the RBI is having. Look, it's hard to say if the corporates were doing it in a big way, because those tides can continue to shift depending on the situation. But just, understand the size of the markets relatively. The onshore market could be about $70-80 billion, whereas the offshore market could be much larger, about $140-150 billion. So the point is that, the moves in the offshore market can be quite impactful on the onshore market in case that linkage was very much alive. Now, the RBI has effectively diminished that. And that is why perhaps the onshore price or the onshore rupee could behave in a much more palatable way, at least from an RBI's perspective.
The onshore and the offshore market, Dheeraj, at a fundamental level, I know the signaling effect, right? I mean, what happens to one price and there's a signaling impact. But fundamentally, they're kind of different markets, right? There is no linkage, Dheeraj.
Look, what happens is that if your offshore market is pricing, let's say, a much weaker rupee than the onshore market, there were initially arbitrage opportunities that could be availed by the corporate treasuries or via banks,
Right.
and that is how the offshore pressures in the rupee got transmitted into the onshore pricing. Now, in the events of global shocks like oil prices, such as the one currently playing out, offshore markets tend to react much more strongly than onshore markets, because onshore markets typically respond to trade flows, remittances flows, and things like that, where offshore markets have a bigger element of betting to it or speculation.
Yeah.
So to limit that linkage, these regulations have been put out because, of course, as we have seen, the rupee continued to make fresh lows despite RBI's efforts, despite strong amount of selling both in the spot and the forward market. So I think this is a wholesome tightening of rules so as to control where the rupee is or where it is headed.
Got it. Dheeraj, we'll leave it there. A useful chat. Appreciate you coming on here on CNBC-TV18. Well, I think let's just get the 9-10 calls out of the way. So, Darshan, what do you have?
It's SRF, buy SRF with a stop under 2,510.
Okay, SRF is a buy. Do we have... okay, I think that's SRF, and that's Sudarshan's call. I was wondering if we have Shilpa as well. We have our own Sudarshan with us with the top brokerage calls of the day. Sudarshan, or rather Sud, what's on your list?
So Bernstein has initiated coverage on ICICI Prudential Mutual Fund with an outperform call, and target here is 3,500 rupees per share. It says company has consistently delivered trifecta of strong fund performance, rising flows and tight commission control. It values the company at a premium to peers because accounting for its inviolable trifecta and alternatives business. And it also says that CIO is a driver of their fund performance, while near-term stability is there. Eventual succession will be a concern. On Aavas Finance, Citi maintains buy call with a target price of 2,100 rupees per share. It says company has delivered disbursement growth of 16% YOY and 36% on a sequential basis. Also, AUM, that is assets under management, expanded by 15% on YOY basis and 5.8% on a sequential basis. That is in line with estimates. It expects credit cost to remain benign at 10 to 12 basis points and expects company to deliver ROA of 3.6% and ROE of 14.9% in Q4 FY26.
Right, Sudarshan, thanks a lot for joining in. And speaking about Aavas Financials, the brokerage call on that one, we are about a minute to open, but meanwhile, the Asian markets have slipped further. The Kospi is now down about 4%. When we started the show, it was down about 2.5–3%, and that's extended its cuts. The GIFT Nifty was indicating a sharper cut, but at the same time, we have the pre-open, which is settled about 300 points lower, which is about 100 points higher than the previous low that we saw on Monday, around 22,284 thereabouts. But one stock which is actually doing well in pre-open, has settled about 5% higher, is VMart Retail. So last couple of trading sessions have been good for retail stocks. VMart Retail's fourth quarter update has the stock doing better in the pre-open at least. So let's see where that settles. But by and large, there has been a fair amount of weakness even in the pre-open. No notable gainers or losers that stand out. 24% revenue growth is what VMart Retail has reported in the fourth quarter with 12% SSSG.
Yeah, there's VMart for you, and we'll have more stocks coming up. Kospi, by the way, as Mangalam said, right, it's down 4%. It was up 8%. It closed 8% higher yesterday. So there was a massive move. Of course, Kospi is also one of the hardest hit from the 27th of February when the war began. So it had this massive 8% surge and kind of 50% of it being given back as we speak. So that is, Asian markets for you. We've got the first trade starting to come up in just a bit. We will look at headline indices and we'll look at individual stocks after that. So it's lower, but can we... I mean, it's going to be something we can live with as we go into this longer weekend. 300 points down to 22,341 on the Nifty, so 22,330. The sensex is down about 1,200 points, 71,900 odd levels. Nifty Bank is down 2%. Nifty Bank went up, I think, 2.5, 3 yesterday. Mid-cap index is down 2. The small-cap index will come up, and I think there is a cut appearing there as well. It's about 5:1 in terms of declines to advances ratio. So about 1,600 stocks are down, about 300 stocks are higher. And that is the picture at this stage. L&T, Mahindra, Eternal, etc. The Nifty heat map will give you a quick snapshot view of how things are. It's basically like a manic depressive market, right? We had a By the way, we are below the low that we made on Monday. Yeah, 22,280 was the low, and we are about 22,230. So yeah, I mean, we're down 450 points. So this is the GIFT Nifty showed at about 8 in the morning. Approximately that, maybe even a little worse. All 50 down. Yesterday we had everything up except one name, which was I think in the red, and today it's all down once again. We've had these all red, all green days now for a while. Mangalam.
That's really the fear, in the market. Every time, every week we start with a new panic low. Thereafter there is a recovery, and towards the end of the week we hit another panic low, and that's exactly what's taking place today as well. 22,220 thereabouts was the low of the day. We've seen about a 40-point recovery from there, but it's extremely volatile. Early days of trade, and that's the kind of move that we're seeing. Oil marketing companies, worst hit. So we have BPCL, IOC, HPCL, all of them lower in today's trading session. Interglobe Aviation, which is doing well in yesterday's trading session because the ATF cuts were not as, or ATF hike wasn't as much as one was expecting. But now oil prices are back to $106 per barrel. That stock down 4%, among the top Nifty losers. Like you pointed out, all Nifty stocks lower. Let's look at AU Small Finance Bank in the broader markets as well. That's lower. SRF, which was one of the long calls for Sudarshan. Actually, I think the open itself could have been stopped out, down 4.5% for that stock. Hindustan Copper, Godrej Properties, Aditya Birla Capital. Be that as it may, it's a big cut is what we're seeing. The only stock that really stands out in terms of gains is V-Mart Retail. Settled about 5% higher in pre-open, and now as we speak, it's up around 8.5%. So a big move is what we're seeing on V-Mart Retail, and that's reflected or rubbed off on a couple of other players as well, the likes of Page Industries, which is marginally higher. But, it's just V-Mart Retail that stands out in terms of an up move, nothing else.
Well, plenty of stocks, Mangalam, comment for selling. Bank of Maharashtra down 4%. High volume loser today. Your Agility that's falling on large volumes as well. 3.5% down out there. Bandhan Bank is the other one that's taking it on the chin. That's down another 3.5%. BPCL, these OMCs are going to have rough times ahead because the way the crude oil prices have spiked, and now they're staying stubbornly high as well. So the marketing margins are going to get impacted. Those stocks all under pressure. What's doing well, Websol Energy, for some reason, that stock's up close to around 2%. So keep an eye on that one. Ola Electric is more or less flattish after the run that we saw yesterday, post the sharp correction that we saw earlier. Vedanta has given up some part of the gains that we've seen as well. We'll have to keep an eye out on a few of these large names that will have to bat for the bulls. I think HDFC Bank will have to give up this underperformance of being down close to around 2%. So that's going to be a stock to track today. It's getting very close to the recent low. So keep an eye on HDFC Bank, Reliance Industries as well. That big boy will have to stand up and get counted if the bulls need to fight back. And the tech pack, their one as well, will be in focus. We'll have to keep an eye out on these three parts of the market. If we need to see a pullback, the tech index actually in the last 1 month has been a relative outperformer. It's down only around 2% when the markets have corrected more than 10%. So I'll keep an eye out on that one. Reliance and HDFC Bank. Let's see who's going to come out and bat for the bulls.
Absolutely. Well, I think, it's down about 22, 230, 240, about 1.9, or 2% lower broadly. I mean, actually, all indices are down 2 or more as we start this session. It's a completely down and out day that we are seeing. Well, let's bring in Sanjay Mukim, who's with us now. He's head of India Equity Research at JP Morgan. Sanjay, good morning. Good to have you with us here. Thanks for joining in. We'll get to talk to you, tell us about equity targets and markets. But you also track the oil and gas space, Sanjay. And I want to just start with that. In your interactions with companies and, policymakers or experts, etc., are we likely to see the availability of fuel become an issue? In your because that's the real one, right? Higher prices is one, which hurts, but availability is another thing altogether. Is that something that you're building in?
Well, Prashant, I mean, this is something that obviously everybody in the country is working very hard to manage. But if you look at the three broad commodity baskets, which is crude oil, we're doing reasonably okay. I mean, some preliminary data suggests that our March month purchase of crude was down a little bit, but it was more than enough sufficient. Companies are suggesting that they have enough crude oil to run their refineries almost fully. So at least on the crude oil front, we've been able to manage the March month reasonably well. And I suspect that Indian refiners have the ability to source enough crude for the visible few weeks as well. So I think that crude situation is reasonably okay so far. Natural gas availability is down because Qatar was a large supplier of LNG globally. And this is causing some bit of rationing to industrial customers of natural gas in India. We've published notes where we've tracked the consequent shutdowns as a result of a lack of gas availability. And LPG is something that is in the media all the while. And so far, it does seem that most households have been able to find some sort of a cooking gas solution. And LPG supplies have been managed as well. But this is something that requires a lot of hard work to maintain, to my mind, Prashant. And you always run the risk that if the situation deteriorates further, you may have some supply challenges.
And the oil that we are buying now, Sanjay, what are we paying for it? The imports?
It's a great question because it's a moving target now. Because what's happened is two things: is that our basket has shifted, right? So we no longer buy as much Middle Eastern crudes. So you'll see a lot of people talking about the India crude basket being a very high number because they're using an older basket weightage. India has now shifted more to buying a large amount of Russian oil and a large amount of Brent-linked oil. But the problem for us in answering that question is that we're now paying premiums for some of these oils, which premiums are not easy to determine based on Bloomberg quotes at the moment. So I'd suggest that when people look at India's basket weighted average, you tend to anchor it of Brent, not a Dubai or an Oman quote, but still add a little bit of a premium on top.
So you're basically in the I mean, again, this is you know, so in the 110, 120 range.
Yeah, I would say that, look, if you include shipping, if you include the premiums we're paying, we probably add another $10, $11 over whatever the Brent quote is. I think it's now 115 today, 106.
106, yeah. So basically another 10, 15 on top of it, roughly.
Finish is more that I'd lean to, but yes.
Yeah. So availability for now, I mean, as you're saying, we'll have to work hard to maintain it. So there's no disruption in that sense. And of course, price is up as well. So what does this mean? What does this combination in that sense mean, right? For businesses and for companies under your coverage, what are you hearing, Sanjay?
I think businesses are facing a tough time. And especially, as always happens in these situations, smaller scale industries have greater challenges in maintaining supply and sourcing of raw materials, packaging materials, etc. And we've seen this happen in previous instances of distress as well, where large caps ended up gaining market share as a result of this. But like I said, we are hearing, and again from media reports, etc., of a number of small industrial clusters, etc., having to take production shutdowns because of a lack of raw material. It doesn't seem to be very widespread just yet, thankfully, but that is a risk the economy runs for the next several weeks if this war doesn't end. Because what will happen, Prashant, I think, is that for the first 3-4 weeks of the war or the disruption, many industries survived of inventories, of distress purchasing of materials. But then these costs become too high and you are not able to contain or maintain production while paying for such high costs of input. So you might see an increased proportion, increased number of industries which decide or choose to take a break in production because of costs or availability of fuel.
Right. What do you call on valuations in general? Because, every once in a while we do get commentary around recalculated valuations, the 1 year forward, 2 year forward on the Nifty, and but they do not account for the potential earnings cuts that may come by. So while the multiple at an absolute level looks like it's reducing and a little more attractive, what it doesn't account for is the concomitant earnings cut that may come by, which would limit the valuation becoming a lot more attractive. So where do you see earnings pan out over the next, say, 1 year or so, given this conflict? And to that extent, how much is the valuation correction?
I think, look, let me try and sound a little bit bullish here. Okay. You will see earnings cuts, right? That's a given. You will have to calculate the negative implications on GDP growth, the higher inflation, and these revisions will be larger the longer this conflict and disruption lasts. We know that, it's obvious. But if you take a 15-year or 25-year view, India's EPS has almost every year been downgraded. There's only been 2 or 3 instances where you've seen upgrades to a starting Nifty EPS forecast. During COVID we saw it, and a couple of years in post GFC, for example, we've seen it. So that downgrades will happen are known and par for the course in Indian investing. This year you may have a little bit more than usual, but if you are getting the index at on headline 17.2 PE now, while global equities still remain relatively expensive, right? So India, not just in absolute terms, looks okay, but in discount to regional markets has widened a little bit. Then I wouldn't get too bearish on the valuations per se. Yes, that 17.2 or 17 now with today's correction, is close to average. It's still not at a discount, but it's not too far away from what you would now call fair value.
Hi Sanjay, good to see you in. But some argue that maybe India doesn't deserve to get that kind of premium multiples in comparison to some of the other Asian peers. What do you make of that argument? It goes down to 15 times, sub 15 times. Or do you say no, return ratios are better? We have, bigger earnings trajectory out there. The central government has put in a lot of reforms that will hold us in good stead in the time to come. So you wouldn't buy that argument that India actually, that valuation premium needs to decrease further?
Well, I'll copy a comment that one of my team members made to me the other day, which is India tends to disappoint both the optimists and the pessimists. So I'd say that, look, if you've written a lot of research why India deserves to gain premiums, we have a demographic dividend, we have multi-year growth, you pull out all those reports and read them again. Right? Some of those arguments are valid, right? India will have growth over the next 15 years, which is rare for many developed economies. Now, whether that number multiple justifiably is 15x or 16x or 17x is debatable. But as multiples are falling, it is looking reasonably more reasonably valued to my mind.
All right, more reasonably valued.
So I don't think that there's anything called deserve. It's just mathematical.
Got it. All right, Sanjay, it's a pity actually that this war broke out, because I recall the last time we chatted, at least things were looking a little bit more optimistic, with number of downgrades had started reducing, and there were some earnings surprises that were coming about as well. And to be fair, January and February actually were good for a lot of sectors, but March has spoiled the party. That said, I think you were also hoping that private capex actually will come back in FY27. Now, a lot of companies will actually hold back on capex because uncertainty has ballooned up in this sort of a geopolitical scenario. Another year of no uptake in private capex would be fair to say?
It would look like. And many of those assumptions, you're right in saying that the economy was showing signs of a little bit of a cyclical uptick in the early part of the year. But this disruption will change a lot of things. And the way I pitch it is that, look, you see a V-shaped recovery in supply instances, right? So if things are shut, once the Strait of Hormuz opens in a couple of months, supply will go back. And you will not be talking about oil shortages or gas shortages, hopefully in a short period of time. But the demand projection will not be V-shaped. The shock that you've gotten to consumer confidence, that the expectations that have gotten weaker at the moment will take a long while to repair. And of course, you might actually see some tightness, right? Whatever the RBI does, in defense of the currency might actually lead to some macro tightness for a while. So yes, recovery will now have to be a slower grind, and you will have to wait for consumer confidence to come back, corporate confidence to come back before you start to see, the much anticipated recovery in capex, for example.
Right. Just as you spoke about the RBI and the currency, there's been a sharp rally in the rupee right now. It's actually at the high point of today's trading range. Opened at 93.53, went up to 93.62 thereabouts, and now just suddenly has strengthened to 93.30. So that's the kind of move that we've seen on the rupee. 93.32 is where we are at, and this compares with closer to 95.2, 95.3, which we've seen as a record low on the currency. The rupee dollar at the strongest point of today's trading session so far. Sanjay, sectors. Let's get sector specific. What, according to you, right now seems a lot more attractive as a bet for the next year as against what it was, say, 3 or 4 months ago? And where would you still stay away from?
Well, look, if you take a slightly more medium-term view, the valuations of the financials cohort, especially the large banks, are looking very tempting. There is a macro risk. If oil prices stay where they are, you will see continued policy interventions by both the RBI and the government to manage the economy. And many of them will be in the direction of tightening the economy, to my mind. And that's why the bank stocks have been under pressure. But if you take a medium-term view, these multiples look reasonably attractive to my mind. I don't know when things will improve or what will change positively, but you may not have too much downside at current valuation. So banks, large cap financials look very interesting. I can't say this for a 3-month or 4-month view, I don't know. But for a 3-year medium-term view, the valuations or the entry points you're getting today are very attractive to my mind. This cannot be said for most of the broader market. I think the consumer discretionary pack valuations have come off, but I wouldn't qualify them as being below average or distressed multiples just yet. So our focus would remain on the financials. Of course, I will highlight that this is a macro trade on banks. And if in India you see continued tightening because oil stays up, then bank stocks will continue to suffer in the near term, of course. But that's where it makes sense. Couple of sectors where I've seen client interest in the recent past has been, let's say, in the power sector, because it's more insulated. There is expectation that demand might improve. IT has obviously found favor again because it's a good defensive, healthcare again. But these are more seen as defensives in the current volatility, rather than to look for them as having big earnings growth or earnings revisions.
Sanjay, just two other areas, I think, where you coverage. One is actually one of the stock, Premier Energies, I think, is you cover it, right? It's one of those stocks which has gone the other way. From the start of the Iran war, stocks gone from 700 to 900. I think Nimesh put out a piece a few days back and he highlighted this one and others which have basically done well amidst all this chaos. I don't know, I mean, any thoughts here?
I can't comment on single stocks here, of course. But what I'd say, Prashant, is that one of the two lessons that investors are trying to take away from the current, let's say, the March geopolitical developments, is that most countries globally will look to increase investments in two sectors. One will be defense, and we can all agree that defense expenditure will remain supported in the current uncertain environment. But the second sector that everybody is trying to think about is investment in renewables. Because how do you reduce your reliance on imported oil and gas? Is to electrify economies. And there, the contribution of renewable energy could be material in the years to come. Now, there isn't anything material happening now, but I think that theme is finding favor amongst a lot of investors. And I think it makes sense.
Yeah, okay. And the other one is oil and gas. Within oil and gas, stocks under your coverage, oil marketing companies in particular. Anything to do here or just wait and watch, Sanjay?
The current situation is reasonably volatile. I think it's very difficult to take calls until you know where oil prices themselves settle eventually. And the currency also matters for all of these companies. And, if you ask me where oil will be FY27 average, it's a very difficult thing to point to now. So I think in many of these stocks, there will be changes that will happen because of the direction of oil, because of policy, because remember, governments cut the excise duty, but it may be tempted to raise them back again. You do need the revenue. And at some point in time, you may be forced to therefore raise retail prices also. So all of these things are uncertain, and therefore, clouds the view on the sector for now.
All right, take that point, clouds the view on the sector, but over the next year or so, you are positive on financials. You do believe that valuations are reasonable, notwithstanding the downgrades that would come by as well. Let's get in a comment coming in from corporates on the back of that. Sanjay, thank you so much for joining in and setting the tone. As the West Asia war enters week 5, no signs of de-escalation. Palm oil prices in Malaysia too have surged over 14% so far in 2026. Rising cost pressures clouding both demand and margin outlook for companies. Let's speak to Patanjali Foods. Sanjeev Asthana, who's the CEO, joins in. Sanjeev, thank you for joining in. Two-part question. One is on this war. How has that impacted availability of raw material inputs for you? Packaging costs, etc., have increased. So could there be a margin impact because of something like this in the fourth and the first quarter, the very near term and the medium term, if you could give us a sense? The second part is because of a policy change in Malaysia, palm oil prices are the highest that we've seen since December 2024. How does that impact your business? So on both those factors, if you could comment.
So two big events have happened in the veg oil sector, especially in palm oil. One, that Indonesia announced, B50 for the biodiesel mandate, what they have, and which is going to take out nearly 3 million tons of palm oil availability from the global supplies that they typically do. But my sense is that for Indonesia to go and implement B50, it will take good 12 to 18 months for that to occur. So the immediate rally partially that happened was on account of the sentiment that started to impact it. That was one. The second issue, which at a fundamental level, where palm oil tends to follow the global crude prices, and you've seen the volatility in the Brent. It touched 120, came down below 100. Again, it's up today. So palm oil is quite a substantive way reflecting the energy prices, and that is where the worry is much larger. So it has moved up by nearly $200 in last 2 months. Soya has moved up a lot more. So the supply side security is still, I would not say that it's a major alarm, but from a from the origin perspective, we will see that some bit of disturbance because the freight rates have gone up. The insurance rates have skyrocketed in last 5 weeks. We are witnessing changed pricing, especially from the major suppliers. So I think that is going to have one large impact from the supply side. On the demand side, clearly the issues on, as you mentioned, the packaging costs have gone up between 25 and 30%. We're clearly seeing that, some bit of demand, has collapsed on account of the LPG shortages that we're witnessing in the HoReCa segment. A lot of industries do have a challenge currently in maintaining the capacity. So that kind of offsets if there are any supply challenges immediate basis. But my anticipation is that we are comfortable for next 45 days to 2 months. Post that, if this continues and there is no solution to the Gulf War, we may have challenges on the supply side. And we should not forget that India is getting into the peak monsoon period. Those predictions on the monsoon side of could this be an El Nino year, so the domestic supplies, etc., if they become a challenge, could be a factor that we'll have to all price in.
So what does all of this then mean for your immediate volume growth and margins for the edible oil business?
I would say that margins is positive, certainly, because you do know that we carry long only inventory for supply chain. So anytime the prices spike, it tends to benefit us. But I would not, take it too much into account because tomorrow these prices could collapse as well, and we'll have to pass through the benefit to the consumers. So broadly, I would say that from a margin perspective, supportive. From a volume perspective, comfortable. But from a risk perspective, exceedingly high risk that all companies have to grapple with.
So edible oil margins in the last 3 quarters, 1.2%, 3%, 1.9%. You said that sustainability between 2 to 4% is what your target is. Fourth quarter, what is it that you would end up doing? And the first quarter, because of this spike that you've seen, the impact of old inventory, etc., can we see it cross past that 3.5%, 4%?
So I wouldn't talk about the numbers of the fourth quarter. We are, absolutely in a silent period. So the numbers are getting worked out, but the numbers will be positive. Quite a bit what we've spoken before. I think we should be able to meet most of the objectives, but I would refrain from commenting on the margin part. But broadly, the first quarter in this year should be very positive in the way it has started out. But it's early days. We're just into the day 2 of this quarter. We'll have to see that how this plays out.
What about the other parts of your business? The FMCG business, which you expected to grow at around 15%, foods portfolio between 8 to 10%, home and personal care. Because of increase in edible oil prices, there would be an increase in derivative prices for that as well. That could impact their raw material and packaging prices as well. As you pointed out, up 25 to 30%. So what does that do to that part of your business?
So that is a challenge, without a question, that we will witness a lot of volatility on the front of, as the input costs have gone up and the input inflation immediately impacts the end prices that we can, give to the consumers. And as you know, that FMCG sector is very difficult to pass on the price increase. So right now, the efficiency for not only for us, managing supply chains, managing volatility, re-managing the risk in a new dimension that is there, I think becomes exceedingly important. So FMCG sector is more challenged than the veg oil sector right now, at least for next 2 months. Clearly, we are witnessing a severe food inflation, which is impacting, the biscuit segment. It's impacting all the production systems. LPG supply constraints can impact your production scheduling. So there are a lot of challenges on that front. And we'll have to see how this goes. But the company is quite optimistic that if this were to end in, let's say, 2 weeks' time, and the prices were to come back to normalcy, I'm expecting that there will be a severe collapse if the Gulf War, this Iran war tends to settle down. There'll be an immediate drop in the prices across the board. So then it should be comfortable back again.
What about, the oil palm business? We've been speaking about the company wanting to be, and the country wanting to be a lot more self-sufficient when it comes to this. You had embarked upon this journey. How far along are you on that? And at what point do you attain self-sufficiency?
So self-sufficiency on an overall basis perhaps would not happen. With 8 years' time, we are estimating that we should be producing more than 1 million tons of palm oil. But that is still 8 years down the line. Right now, just to give you a flavor, that we are doing We've already planted 115,000 hectares across the country, which is quite a record. This year, on a margin basis to the third quarter, which I've already sort of mentioned, we made nearly 325 crores of EBITDA. So any time when the prices go up on palm oil, it tends to benefit our oil palm business quite substantively. So I'm very optimistic about that business, that from a growth angle, from both from revenue as well as from the margin perspective, I think it will be one of the strongest businesses under the Patanjali Foods fold in the coming years.
All right, and a final question before we let you go. Sanjeev, the last time you joined us, you did say that you are very close to making an acquisition announcement, and this was to perhaps increase your distribution capabilities. Where are you on that?
So we'll wait for that. I think right now, it's just very early stages. The acquisition parts, you do know that it may or may not happen. The times have changed right now. So I think managing our house is much more important right now, and navigating through the challenges, and we will pick that up later.
All right, take that point. Thank you so much for joining in and giving us a flavor of what's actually on the ground. A lot of your raw materials for FMCG have seen a big increase. Palm oil prices are higher, which is actually a positive for your edible oil business, largely because you're sitting on old, lower cost inventory that could improve your margins very near term, may have an impact on volumes going forward, but let's see how that pans out. 2% lower on Patanjali Foods, but that's exactly how the market is as well. Almost 430 points lower on the Nifty right now as we speak, with the mid-cap index having it worse. What we'll do is take a short break, come back, focus on this geopolitical situation, and have former diplomats Anil Trigunayat as well as Ashok Sajanhar joining in to discuss this.
Welcome back. I think markets, of course, try to come back up a little bit, but this is, of course, we'll see all kinds of price action, but the close into the 3-day long weekend is going to be important, and there are many hours to that. For now, a little bit of a lift from the absolute lows, 22,263 is where we are at. So, of course, it's the war in the Middle East and what happens next, which is on everyone's mind. This is going to be a shock which we'll have to live with for much longer. Let's get some guests in who've seen these, not exactly, but no situation is repeatable in the exact frame, but crises before as well. We have Anil Trigunayat and Ashok Sajanhar, former diplomats, both who've of course been with us here on CNBC over the last many months, sort of talking to us first, sort of running us through that entire India-US trade deal situation, and now, of course, it's basically back-to-back, the Iran war, which has come through even as things were starting to look a little better at the margin. Thank you very much for joining in. Mr. Trigunayat, so where does this leave us? It's a bit of a precarious position for macros. We just had a gentleman from JP Morgan who said that our purchase of oil perhaps is now around $120. And we buy about 5 million barrels a day. So it's a very material question. If this runs higher for longer, you're going to be, it's a lot of dollars out suddenly, which has other implications. To you, my question is, it doesn't look like the war is going to end anytime soon. We heard from President Trump earlier. But should we look at the situation separately? The US halting its strikes and the Strait reopening?
Well, in the first place, I would say, and you are absolutely right, this is one of the major repercussions of this war that was always feared. That's the reason that the countries actually all over the world felt that this war should not happen. Unfortunately, during President Trump's bravado or whatever, he was misled into this war. as you could see today from his body language, that he looked rather sad, distracted, and just going through his usual rant. And there was nothing that came out of it. He only gave a little indication that they have achieved most of their war objectives. But at the same time, this 2 to 3 weeks will take to mop it up. He did not say anything about the Strait of Hormuz directly opening it. So there are two things in this. One is either they will try to get in and get their boots on ground somehow and in the coastal areas, or they will just walk away and let the NATO member countries, the Europeans, which also still buy some oil and gas from there, could do that. At the same time, indirectly or directly, it has also helped the Americans to an extent, because he was doing the marketing pitch that if you want to buy, you can buy from us. Otherwise, go and fetch it from the Strait of Hormuz. So he has put the world into a very, very difficult situation, in fact. As far as India is concerned for us, I always say that this region and their security and stability, frankly, is of existential importance for us. Despite the fact that we are getting about half of the energy from there, that is very, very critical for us. The sea lanes of communications are very important for us. The safety and security of Indians who remit about $70 billion is also very important for us. We have huge investments in the region. They are all our strategic partners currently at war. So I think that this situation has put India in a very, very bad situation. So as the oil prices go up, and the rupee comes under greater stress, as we have seen in the recent, so it will have a double jeopardy for us. Fortunately, we have diversified our imports, but it takes time to further, get it from different things. I think we'll be focusing more on Africa, more on Russia, as we have done it until now. And the Iranian oil has also become available to us. First consignment or shipment has arrived. So I think that this is something that will probably hold us instead, but it will definitely have an impact on the overall health of the economy. Not only ours, but the global economy as well. So it is in everybody's interest that the war stops sooner than later, because now the economic, health of the Middle East itself is in great danger. Yesterday, the Amazon office in Bahrain was attacked, and the Iranians have taken out a list of all top companies, American companies, who have offices in UAE and in Saudi and Qatar and elsewhere, their universities. So I think if that is happening, and then the desalination plants are hit, I think we are going to get into a very, very major problem, and which will have a very grave impact globally. In fact, as you know, that IEA, IMF, and World Bank, all the three heads have worked out a committee to work upon the impact of this and how to get by it. So let us see. There are still some talks going on. There is a little bit of a hope there. But I think that in this fog of the gray zone warfare, it is very difficult to say exactly which way the wind is blowing.
All right. Hi, sir. Good morning. And very valid thoughts coming in there. And as you pointed out, Mr. Trump looked a little bit different from what he's looked at in the past. The body language clearly gave it away. Would you say that now it's for Iran to call the shots and they'll have to, pull the curtains down on this war? Because Mr. Trump, it seems, there's no big positives coming out for him. He's losing out in terms of popularity. He's getting himself into a bit of a fix in terms of the economics as well, with the bond deal spiking out there. So it's now for Iran to actually call the shots and close down this war?
Well, I think that the Iranians feel, I'm not quite sure that to what extent, but they feel that they are probably, if not winning, at least making it extremely costly for both the Americans and the Israelis and for the global economy. So their hope was that all these Gulf countries, which are losing billions of dollars a day, the Americans who are losing billions of dollars a day, would actually be pressured into curtailing their war effort. But that is really not happening at the moment, because the Americans are stuck in this groove and they don't know how to get out of it. President Trump has made several statements, and in fact his today's speech, which was on nation, addressed to the nation, normally should have said something more, but it has not. So either it is their war strategy, or it is that they have really nothing much to say. They are just hoping against hope that the Iranians will somehow fold and will ask for this. But if the Iranian statements are to be seen, they are clearly saying that we are not asking for ceasefire, we are not for the war. But in fact, the whole problem is that every time you repeat the same thing which have no basis, loses its credibility. For example, the nuclear discussions, they were having it, and there was almost a deal of the table. They didn't take it. Now they say we are moving the nuclear weapons. And then you see the missiles. That was also under discussion. They would not agree to that. Then they bring in proxies. So when you have shifting goals, shifting objectives, and they said the missiles are going to hit the United States, their own intelligence has not corroborated it. So this is the kind of thing when they cannot convince anybody. On the other hand, there was a letter, if you have read it, by President Pezeshkian of Iran to the American people, open letter.
Yeah.
I mean, that seemed far more convincing, in fact. So even in this warfare of the disinformation or information warfare, I don't think the Americans are winning the battle.
Yeah. No, absolutely. And I think public opinion, if one were to conduct a poll, a global public opinion is definitely, I think, as you describe it, against this war, and it's quite incredible the way things have turned out. Just a quick word, Mr. Trighan. I just go back to the Strait of Hormuz, because that's the economic impact, right? Iran is saying that friendly ships they've again and again said, right, physical friendly ships are allowed, ships of friendly countries are allowed to pass through. It's not. So how will that work? 2 weeks, 3, or you think, it's all kind of linked together? Because at the end of the day, for insurers, for shipping companies, it's physical safety, right? So as long as bombs are falling in the region, nobody wants to take a risk. But once that stops, Iran may collect a fee or whatever, but countries will pay, especially in Asia, who are largely dependent on oil coming through there.
Yes, definitely. I think that the Iranians have found this model which is being applied in Suez and applied in Panama and other canals, and they are hoping that they will be able to, they and the Omanis together will be able to charge certain fee for safe passage. Unfortunately, as you are aware, that due to this war, this kind of a restriction has come up. It was never there for many. I don't recall that Strait of Hormuz was ever closed in the past, despite all kinds of issues and problems. So it was a free passage for everybody, and there was no problem. Even Red Sea, we saw the Houthis and Americans had signed up an agreement with them. So even the Red Sea and the Bab el-Mandab and all those sea lanes of communications were open. So this is the war that has really generated this kind of a reaction, or extreme reaction. But now that the Iranians will become used to this blood, I think that they are not going to give it up. It will be very difficult. They will start charging, may not be $2 million per ship, but that will definitely bring the cost up, as well as the insurance costs. And of course, the shippers are definitely worried about it, and it's already about hundreds of ships that are still in the waters. And the Iranians have said very clearly that except for United States, Israel, and those who are aligning with them, rest of the ships will be free. Even today they are saying, although the conflicting reports are coming from IRGC and the government differently, they say this is closed now. So I don't think it is closed in that sense. It is actually, the gate will be open if you are not against them, a neutral country, or you are paying the fee and you may be allowed to pass. So, but this is something which will be untenable in the long run.
Yeah.
These kind of high prices.
Yeah, no, absolutely. And the world, of course, is paying the price for it. Mr. Trigunya, thank you very much for joining us. Good speaking with you. And
thank you. Pleasure.
I hope to have you back on as we continue to track developments out of the Middle East. Well, the dollar rupee is the other story, right, which we are tracking. And I think we have Anandya Banerjee joining us now from Kotak Securities. Anandya, good morning. Good to have you here. So circular after circular. Basically, in a way, completely delinking the onshore market and the offshore market, right? And depriving the offshore market of any dollars. What does this mean? And, we are seeing what we're seeing on the price, Anandya, right? But what will, is there a signaling effect for things like equities, flows, or not really? Because this is, at the end of the day, these conditions have been created through these circulars and these measures, which may be necessary, but is there a signaling effect?
A very good morning, and thank you for having me, Prashant. Actually, the delinking thing is right because the broad action of the RBI is that any form of speculation and anything that can incentivize speculation, be it in the form of hedging turning into speculation or arbitrage onshore, offshore, has to be curbed, and that's what the RBI has done. It is understandable because we are in an unprecedented kind of a situation like we faced in during COVID. So as long as this situation persists of the energy shock, I think the RBI is trying to say that we have to clamp down on the activities in the currency market.
So yeah, basically banks can offer NDF as a way to hedge, right? I mean, everything has to be done onshore here. That's basically the message.
Yes. So in 2020 and 2022 or 2023, the RBI allowed the Indian banks first through the IBUs to operate much more freely in the NDF market. And so the liquidity which the bankers started to provide in both the markets actually allowed these two markets to see a significant jump in the volumes. But what happens with the NDF is NDF impacts your onshore market two ways. One is signaling, as you said. The other is actual transmission through arbitrage. So when NDF is quoting a premium because of let's say, an oil shock. So what will the banker do is they will buy here and sell in the NDF. So automatically that upward pressure on the dollar is transmitted in the onshore market through this arbitrage. So RBI is saying that actually we want to clamp down on it, and also the bankers actually used to provide quotes to large corporates even after market because they had access to NDF. Now RBI is also saying that is not permissible now, and plus you cannot trade through the related parties. So basically they are telling the banks that you have to liquidate your excess dollar positions, which you have until 10th of April. And that's the reason why you are seeing this sell-off in USD INR.
You think, Anandya, the Friday, the month, do you think this new circular came because, as Latha was telling us earlier, that she's picking up that maybe there was some worry that banks were transferring their exposure to corporates. So banks were trying to find workarounds. You think that perhaps this is kind of sort of plugging that?
It's hard to corroborate that, but what happens is that that was the last trading day of the financial year.
There could be importer demand as well.
Yeah. So if the RBI would have suspected that, then I think this circular takes care of it. So it almost closes all loopholes, and it gives a clear instruction to the banks that they have to liquidate their excess dollar positions in the onshore market.
Yeah. To be fair, I think on Monday, even as we were seeing all that price action, there was still some residual expectation that there will be an extension of the date itself, right? From the 10th of April.
Yes, but after this circular, that looks remote. And that is...
No, I'm just saying the reason why we kind of saw all that rupee starting stronger and immediately falling once again, maybe people did not close out positions hoping that there perhaps could be an extension. But of course, now that is completely out of the window. So what happens now, dollar rupee here? I mean, it's RBI is in that sense now the sole mover?
Yes, exactly. So it depends on how strongly the RBI comes in, because what has happened since mid-Feb is that when RBI was intervening aggressively in the market through the forwards, the bankers were actually taking the other side of the trade, which was fine because you had that arbitrage to play. But now, when the bankers are going to liquidate their dollar longs, the only person who has got the who can take the other side is RBI. So whether RBI steps in at these levels around 93, or they wait for lower levels, we have to see. But till 10th of April, this factor will be a dominating thing. After 10th, I think we are back to oil.
That dynamic of covering basically will be there till the 10th, right? I mean, squaring off basically positions will be there.
Right.
Yeah, no, absolutely. Thanks very much, Anandya. Good chat, good conversation, and we'll come back to you. And, it's all happening with the oil being the primary mover and then feeding through everywhere else as well. There's a new listing which is coming up as well. Powerika is the name of the company, and we should be able to show the first rates which are coming through 2 minutes after 10 right now. So yeah, on your screen now, it's about 6% lower, 372. Secondary markets, of course, not as active, not active at all in that sense. They've gone into a bit of a freeze, but one or two listings here and there are definitely taking place. Chandan Taparia is with us at Motilal Oswal Financial Services with some technical view on things. Chandan, good morning. Good to have you here. A quick word, Nifty Bank, and what to do now?
Good morning, Prashant. Thanks for having me. So index has been making lower top, lower bottom on the weekly chart. And we have noticed that any 1 or 2 days recovery is being sold. Yesterday index recovered towards 22,941. But again, the selling pressure witnessed today. So the structure is weak until Nifty holds below 22,600. Bounce could be sold and it can drip down towards 22,000 to 21,750. If I look at the data setup, FI's long short ratio is near 14%. FIs are continuously selling. India VIX is near 26 marks, which clearly indicates that volatile swings could continue to be there in the market. So till it remains below the key hurdle, overall the downside could open. How to trade in this market scenario? The only way is either to sell on bounce or initiate bear put spread. So for an example, buy 22,300 put, sell 22,000 put, initiate the 300-point spread on any small bounce with the view that overall trend of the market is negative. If I look at the Bank Nifty index, here also the structure is negative. It has been making lower top, lower bottom on the weekly chart, and the sequence is continuing from last 6 to 7 weeks. So till it remains below 50,650, it can go down towards 49,500 to 49,250 marks. Looking at the trading ideas, advanced decline ratio for the market is quite negative, but only one counter which is positive on my radar is DMart. Even after the market weakness, it has been making higher tops, higher bottom on the daily chart from last 6-7 days. It has given a decisive breakout above 4,050, 4,100. So here it seems that overall positive bias could be there or declines could be bought. So on decline, one can buy with support of 4180 for an upside target towards 4400 levels. To sell idea, one is sell on Jidus Life. Structure is negative given a fresh back down below 860 marks. It has been making lower top, lower bottom. So with hurdle of 865, it can go down towards 800. One more sell idea, that is sell on Voltas. Given a breakdown on the daily, monthly, and the weekly chart, has been making lower top, lower bottom on the daily. So with hurdle of 1200, sell on any small bounce for the downside target towards 1110 marks.
Yeah, got that. Chandan, thank you very much for that. Appreciate your time here on CNBC TV18. Those are specific trades. We'll take a break. We're back. Manisha on the other side with commodities on our mind. Oil's, of course, been the headline grabber all through over the last 1 month. Continues to be so this morning as well. Stay tuned. Okay, welcome back. Focus on commodities and aluminum in focus this morning. Manisha is here with just that. Manisha, morning.
Morning, Prashant. There's just two things that are moving in the positive right now. One is, of course, crude oil, and the second is aluminum. Trading 3% on the higher side for LME, so much so that the cash is more expensive than what you have aluminum in next 3 months. This is what we've done in sense of aluminum prices. Last 1 week has seen 8.5% of gains come in. 1 month, 10.5%. For this year till time, it is 17.5% higher, which is much higher than what other metals have done. And if you look at the last 12 months, well, we have seen 41.5% of gains come in for the aluminum prices. So clearly, the best performer between the pack. And I'll show you what the other metals have also done. So in this year, we've done 17.5% for aluminum prices. The best gains that come near to that is tin with 15% of gains. And then you have 5% of a jump up coming in for the zinc prices. And then you have a negative copper for this year with 2% of a decline, and lead prices have declined by 3.5% as well. Well, if you look at gold and silver, the precious metals, that is, they also are lagging behind when it comes to aluminum gains for this year. So gold is up 8.5% and silver just about 1.5%, clearly underperforming not just the precious metals, but many of those base metal prices as well. So when it comes to Middle East, and that is where the major news flow seems to be coming in from, the West Asia disruption could remove 3 to 3.5 million tons of aluminum output in 2026 is the consensus that seems to be building up between brokerages, banks, and the information that is coming out of the West Asia conflict. The disruption actually could cut nearly 60% of alumina supply to smelters in West Asia. So either ways, whether it's about mining, smelting, raw material input, all of that seems to be getting a bit of a hit there. And then you have Emirates Global Aluminum, Aluminum Bahrain, which are reporting damages over this week as well from what they saw in the previous week as well. So we're looking at a consistent and a delayed reopen whenever that happens. And that's not just about it. You have EGS Smelter, Alba, Qatar's Katalam, all of them facing damages as well. So the markets believe that nearly 9 to 10% of aluminum that comes out of Middle East perhaps could be facing a very severe damage going forward as well. And from what we hear from the US president is that after 4 weeks of West Asia conflict, this could drag on for another 2 to 3 weeks as well. And that's exactly what the markets are looking for in sense there. There also is an interesting report that has come in from Goldman Sachs suggesting that an estimated 570,000 tons of deficit is what they're anticipating in this year, versus an earlier estimate of a surplus of 5.5 lakh tons. And the final plate should show you on what the banks are believing on where the aluminum prices could go on from here. You have Morgan Stanley talking about 3,700. Let me remind you that 3,500 is where the aluminum prices are trading at this point in time. So strong gains anticipated. ING believes $4,000 a ton also is a possibility. And Goldman Sachs says that for this current quarter that we are trading within, 3,450 could be an average price for aluminum. So one metal that continues to gain on.
All right, Manisha, thank you very much for that. That's aluminum in focus there. We'll take a break. We are back. Latha in conversation with the CNBC-TV18 Citizens Monetary Policy Committee on what to expect from the RBI next week. So we have Samakanti Ghosh, Samir Chakrabarti, Sonal Verma, Pranab Sen and Sajid Chinoy coming up in that chat in a bit.